is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Downbeat sentiment, Microsoft falls in late trade after forecasting slowing sales for its cloud computing unit. Tesla earnings, they are out tonight. And Tesla invests $3.6 billion in 2 new EV battery factories in the US. We will be watching out for the tech giant's results today. And the US and Germany said to be poised to send tanks to Ukraine. It is a move likely to prevent a fracture to Allied unity, at least for now. Let's check in on these markets. In the doldrums, really, on the back of the Microsoft forecast around ebbing demand for its cloud services business, such a dynamo that has been over the years for Microsoft. And it's a competitive space, so the read across to the broader tech sector is being felt. Just down a little over 0.1% across the European benchmark. Futures in the US pointing lower by 0.4%. Nasdaq futures down by 0.6, and Bitcoin set for its first 2 days of losses, 2 straight days of losses for the year. In the last 30 days, it's actually performed very well indeed. Bitcoin currently off by around 1%, 22,678. Worth noting as well that Jeremy Grantham, of course, famed bear and famed strategist, predicting that maybe you could be looking at further 17% downside for the S&P. That is his call, his warning, of course, as investors weigh up the risks around inflation and possibly over-tightening from these central banks would be the contention from some. We have the map around Europe showing us how things are playing out. Before I get to that, though, a redhead crossing on the health of the German economy. The German January Ifo Business Confidence Index coming in at 90.2, just below the estimates of 90.3. Ifo Expectations Index 86.4. So the expectations index has actually improved versus the estimates of 85.3. The redhead, though, the Ifo Business Confidence Index, the top line, 90.2, just slightly below the estimates. We're going to be speaking to the head of the Ifo group later in the show to get that analysis as well. Of course, the Chancellor over in Germany, Olaf Scholz, saying that he expects that Germany will avoid a recession. We're just quickly checking in on Microsoft now as we weigh up, of course, the comments from the CFO that despite the top line, they did beat in terms of earnings, but it's the forward guidance on demand, again, for cloud and software services, currently down 1.3%. So a little bit of dissatisfaction from investors around Microsoft on that outlook. And that had been the key concern, not just for this company, but for many within the tech space in a higher rates environment. Where is demand going for their corporate clients in particular? We continue to keep across that story for you and the market implications. Now, there is a lot, of course, to digest this morning from the markets, including the tech sector. As I said, Microsoft saying that revenue growth in its cloud computing business will ease, as I mentioned, whilst also warning of a further slowdown in software corporate sales. We're joined now by Paul Leach, co-head of global equities at Barclays. Paul, let's start then with technology. We don't have to get into the specifics of Microsoft, but how concerned are you about that step down in demand? When do you expect to see a turnaround? What would you need to see to turn bullish on tech?
Yeah, morning, Tom. I think tech is clearly a critical sector. I think the big thing for this week is really tech earnings. You know, we saw the start of it last night. I think investors and our clients are going to be watching that very, very closely. A couple of things to think about. One is positioning. I think when we look at equity markets generally and the start of this year, it's been very influenced by positioning. Obviously, the tech space was very much in focus last year, and we saw particularly the large cap tech space sell off fairly significantly. In the last 2 months of last year, the focus has been very much macro in terms of inflation and growth concerns. Now, as we head into Q4 earnings, we turn more micro, and in particular, tech is going to be very much in focus.
So is it a pause from the Fed or a cut that you'd need to see as the trigger to get greater exposure to some of these mega cap stocks, or is it something else?
Well, I think it's a number of things. So on the macro side, people are going to watch the Feds very closely. I think in terms of the market perception on where the Fed is going, that has significantly improved in the last 2 months. I think what is more relevant now, particularly as we go through earnings, for the rest of this week and next week is going to be really that forward guidance that we're hearing from the companies reporting.
And you talk about that market optimism around the direction of travel for the Fed, but there is that disconnect between what we're hearing from the Fed, higher for longer, versus markets pricing in cuts at the end of this year. Who's getting this right? When does the market wake up to what the Fed is saying? Or do you think, in fact, the Fed will be compelled to cut?
Well, look, I think the market, it's an interesting dynamic between the two. I think markets have had, as I said, more clarity over the last, particularly the last 2 months of last year. If you go back to the November CPI print, that was the kind of first signs that there was some cooling of inflation, and inflation was a little bit more under control. Now the markets are trying to balance that inflation outlook with the growth outlook. And I think markets have got used to the fact that the Fed will react as the Fed sees appropriate. And, I think there's still a reasonable amount of uncertainty over the next few months. And, obviously, still those macro elements are going to be driving equity markets, but probably not it's not going to be as pronounced as it was in the last 3 to 6 months of last year.
Okay, so that macro input becomes a little less potent.
That balance of macro, micro is tending a little bit more towards the micro, where it was very macro dominant latter half of the last year.
Paul Leach is sticking with us. Very pleased to say. We'll get more calls from Paul Leach, co-head of global equities at Barclays, in just the next few minutes. Coming up, though, strike action in the UK spreading from the public to the private sector. We're live at Amazon's warehouse in the English Midlands next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Paul Leach, co-head of global equities at Barclays, is still with us. And the view from Paul and the team at Barclays is this: Europe is in a sweet spot. What would have to change your view on Europe versus the US? How much more room does this outperformance have to run for Europe?
Yeah, I think some of this, Tom, is due to the fact that, the data we've seen coming out of Europe in the last, particularly in the last 2 months or so, is way more encouraging relative to expectations. I think the sentiment on Europe has been very poor for most of last year. I think what's also interesting is positioning in Europe is very light. We see that from, the various fund flows that we observe. And, very interesting to see the price action in the first couple of weeks of this year. So first 2 weeks in January, European markets were up nearly 10%, significantly outperforming
So
the
this
US.
has further to run. You want to increase your exposure to Europe. That would be the call. And talk to us about the FX effect, because it was a tailwind. It was a tailwind for European equities last year. Now a little bit of strength coming through for euro. Softer dollar is the call from many. Does that prove a headwind for European equities?
I think the reason, so from an FX perspective, I think if you're looking at, predominantly euro and sterling relative to the dollar and the strengthening that we've seen recently, that while technically you could argue it's a headwind for equities, it's the reason of that strength which I think gives us some confidence. That is really on the back of a fundamentally improved macro data picture that we have seen. And in addition to that, we have seen a kind of a calming of the energy price concerns that we had as well. So, with energy prices coming down, that in combination with the better macro outlook is giving us more confidence from a relative value perspective of Europe versus the rest of the world. And, that is really what's driving the currency strength, so it doesn't concern
And we were
us.
talking before the break around inflation and expectations that maybe it started to pivot, at least in terms of ebbing lower on inflation. But that does mean that margins are going to be squeezed for some of these corporates. Where are you finding margin resilience?
Yeah, look, I think one thing that we're starting to see is, just from a sector point of view, is cyclicals relative to defensives. I think a lot of the equity positioning was in defensives last year. Cyclicals feel relatively under-owned, so that's one area that we would definitely look to. And I think positioning has been a very significant driver of price action so far this year. And, you know, as I touched on earlier, Europe was generally underweight. We've also seen Asia as an underweight as well. And, you know, they are the two regions that have significantly outperformed in the first few weeks of this year.
Okay, Paul Leach, thank you very much indeed. Co-head of Global Equities at Barclays, on the opportunities in Europe, the sweet spot and the fact that much of that remains under-owned, opportunities in cyclicals as well as we weigh up the recession and inflation risks. Coming up, we're going to take the temperature of the German economy. IFO Institute President Clemens Fuest joins us next. Stay with us for that conversation. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get back to what is happening in Europe's largest economy. Germany's business outlook brightened further as the recession many had feared after Russia attacked Ukraine looks increasingly likely to be avoided. That is the top line from the IFO data just out. IFO Institute President Clemens Fuest joins me to discuss the numbers. And Clemens, we always enjoy your input on the back of this survey, the importance of the IFO Institute and its assessment of the health of the German economy. And you put out in your statement, and you say, the German economy is starting the new year with more confidence. How confident are you that that confidence will continue and then indeed Germany will avoid a recession?
Well, it does look like Germany is going to avoid the recession. The expectation until recently was that the fourth quarter in 22 might be negative and the first in 23 as well. Now it looks like we've had stagnation in the last quarter, something the IFO index had been signaling for some time. And now we see a further improvement, not so much in the current business situation, but companies are telling us they are optimistic regarding the next 6 months. And that suggests overall we will avoid a technical recession. We still expect a shrinking economy in the first quarter, but then an improvement towards the summer.
And a lot of this has come down to, of course, falling energy prices and a slightly milder winter than many forecasters had expected. What is your understanding of corporate Germany's ability to remain resilient within the changes that we're seeing around energy?
Well, the most important risk for the German economy was a gas rationing scenario. So not just high prices, but a scenario where there simply wouldn't be enough gas available. In that scenario, there would have been rationing, in particular for manufacturing companies. So the gas plan was, in that case, to, of course, keep up heating, serve households, but let the burden of the rationing fall on manufacturing. And that would have led to a sharp decline in economic activity. That risk is off the table now due to the mild weather. Gas storage is full, and that's the most important factor. There are other factors. We see that supply chain bottlenecks are easing. They are still there, but they are easing. There is optimism that the Chinese economy might be opening up, not quite yet, but in the summer. That does have risks for commodity prices and energy prices, but it will probably further ease supply chains and also stabilize the export demand. So the perspectives for this year are getting better.
And on China then, let's stay with that story because it is hugely significant, of course, for the German economy, which has so much exposure to the world's second largest economy. Which parts of the German industrial base are best positioned for that reopening theme?
It's probably most important for the chemical industry, for the car industry, for machinery, the metal industry. All of these sectors have huge exposure to China. One thing we shouldn't forget is that exports to China are as important as imports from China. So roughly half of all German companies are saying they are getting critical inputs, important inputs from China. So if bottlenecks in the delivery of these inputs improve, this will have a very broad impact on German manufacturing, almost all sectors.
I have to wonder whether what we're hearing from the IFO Institute and the data that's coming through from Germany is just going to bolster the case amongst the hawkish camp at ECB to go higher and longer on rate hikes. And we've heard that from some of the hawks, whether it's Klaas Knot or others, saying, we need at least a couple more 50 basis point hikes. Does that pose a risk to the recovery that we're starting to see, or at least the less dire picture when it comes to Germany's economy?
Yes, the ECB has to strike a balance here, as you say, between fighting inflation and avoiding and overshooting and avoiding producing a recession or making the recession worse. Now, clearly, these numbers we are seeing today do lend some support to the hawks. One thing we shouldn't forget is that core inflation is still increasing. So headline inflation is declining because of declining energy prices, but core inflation is still increasing. We are now seeing an impact on union wage demands in Germany. Public sector unions are asking for wage hikes higher than 10%. And I guess that means the ECB needs to continue increasing interest rates, probably at a lower pace than in the last autumn, but they are not out of the woods yet.
And in terms of balance sheets, as we look at higher rates then, across corporate Germany, is there a vulnerability there? What is the debt picture overall looking like in terms of the exposure to higher rates for these big corporate names in Germany?
Maybe I wouldn't call it a balance sheet risk, because overall balance sheets are relatively solid, but we do see banks becoming more reluctant to lend to companies. In our last survey, roughly 1/3 of all companies are reporting they have talked to banks and didn't exactly get what they wanted. So there are clearly more restrictive financial conditions. And these conditions do have an impact on manufacturing. The bigger impact is on construction. The German construction sector is the one sector where we don't really see a recovery. And that's because in this sector, interest rates and financing conditions are so important.
Okay, that's really, really interesting context. As ever, fantastic to speak to you. IFO Institute President Clemens Fust on the back of the latest line there from the IFO Institute. A gauge of expectations rising to 86.4 in January from 83.2 the previous month. That is, for the context, the fourth consecutive improvement and a bigger increase than economists had expected. Plenty more coming up. Okay, Amazon's UK workers are on strike today at the e-commerce giant's warehouse in Coventry. It is the first time that there's been an official walkout by Amazon staff in the UK. Bloomberg's UK correspondent Lizzie Burden joins us from Coventry. Lizzie, what is the latest where you are?
Well, Tom, you can see the union officials behind me from GMB. They've been stopping the cars and the lorries on their way in, asking workers if they want to join the strike, join the union. And in fact, lots of workers have turned around at the gate and gone home, joining the strike. They're expecting about at least 300 workers to join it today, and it's all about pay, Tom. They want to see a 50%, 50, rise in pay to £15 an hour. They say that they need it to deal with the cost of living crisis. They deserve it because they've worked hard through the pandemic, and they say that Amazon can afford it because it only paid about £10 million in tax in 2021 on about £200 million of profit. That's their argument. Amazon says, though, it's proud of the pay packet it offers, it's competitive, and it's above the national living wage. The workers, though, say that's nothing to brag about. But Amazon really does have to deal with its own problems. It's having to adjust to the post-pandemic retail environment, people going back to their pre-pandemic shopping habits. Amazon, of course, has announced already that it's going to cut about 18,000 jobs this year. That's 1% of its total workforce, the biggest cull in its near 30-year history, Tom.
Lizzie Burden on the ground for us in Coventry outside that Amazon warehouse. Thank you very much indeed. Our UK correspondent, of course, on the industrial strife that's spreading from the public sector to the private sector. Now, we will be covering all things UK every week, of course, on Thursdays at 9:30 in our half-hour special. So stay tuned, or tune in at least for that one. Let's quickly check in on the broader markets before we get to some of the individual stocks. You're looking at losses of 0.3% across the benchmark. ASML coming in with earnings that actually beat, but at its stock is down 1.2%. Aviva rallying at 2.6%. EasyJet up 10% on much better earnings than had been expected and forecasts of very strong demand for travel going forward. Stay with us. We're going to be speaking to Helen Steers, head of Europe at Pantheon Ventures. That interview live from the IPEM PE conference in Cannes with Danny Berger. This is Bloomberg. Welcome back. Downbeat sentiment. Microsoft falls in late trade after forecasting slowing sales for its cloud computing unit. Tesla invests more than $3.5 billion in 2 new electric battery factories in the US. We will be watching out for the tech giant's results tonight. The US and Germany are said to be poised to send tanks to Ukraine. It is a move likely to prevent a fracture to Allied unity. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, it is the final day of Europe's largest private equity event in Cannes. This year's IPEM conference comes after the sector experienced a tough 2022, driven, of course, by economic and geopolitical uncertainty. Danny Berger has been on the ground in Cannes for us this week, speaking to a lineup of fantastic guests to give us insight. Danny.
Tom, thanks so much. And the great conversations continue. I'm really pleased to say that joining us now is Helen Steers. She is a partner at Pantheon Ventures and also is a member of the International Investment Committee that, of course, makes all the decisions for investing for Pantheon. Helen, so great to have you today in sunny Cannes, a great location. Look, it is sunny, but it's been tumultuous in markets, if I can make an awful weather-related pun. We were just talking about this idea. Of course, you have a listed vehicle for which you are the manager of, and it's been discounted by the market, about 40%. What do you think investors are getting wrong?
So it's a really interesting question, actually, because this vehicle, Pantheon International PLC, has actually been around for 35 years. And it's been around through lots of different cloudy weather, whether it was the GFC or COVID or, with the latest sort of perturbations in the market. So it's been through a lot. And it's a well-diversified vehicle, well-diversified globally, by sector, by manager, et cetera, et cetera. So it's a little bit of a mystery to us why it's being discounted by the market. But in fact, the whole of the listed private equity sector is being discounted by the market. We're not the only ones.
Well, I have heard this criticism, again, this is about the whole industry, that perhaps valuations haven't come down in private equity just as a weird quirk of not being marked to market, that things in the industry should look worse. And Cliff Asness, one prominent hedge fund manager, basically says people are making up prices. Do you think that criticism is fair and perhaps plays into that?
So I've read a lot about this, actually, and I think what people are missing, perhaps, is the way that private equity valuations do tend to be quite conservative. And we've got the proof of that, actually. If you look at our listed vehicle and you look at the average uplifts on exit, cash doesn't lie. So you look at the actual cash that you receive versus the last full valuation that the manager has made, and our average uplift over the last 10 years has been 31%. So that means that actually the assets in our portfolio are actually undervalued. And in fact, that's not unusual. When we look at our private equity managers, we track what happens with the exits, very often there is quite a substantial uplift upon exit. And I think it's normal because private equity managers don't like to deliver bad surprises to their investors, so they do tend to smooth the valuations.
Yeah, I'm sure it is very few, if no, investors that would like a bad surprise. What does the environment for exits look like right now?
It's been pretty slow for exits, and I think, if you look at the general environment, it's probably not surprising. We don't rely very much on the IPO market. Only 10% of our exits are actually through IPO. So the slowing of the IPO market actually hasn't affected us too much. Most of our exits are actually to trade buyers, and trade is still there, but for the right assets. So good assets are still being sold, and still being sold at good prices, but there is a general slowdown in the market.
How would you compare that to past crises? Does this one seem more severe than others, or worse? I mean, now, because it's not just a crisis, you also have higher rates now, too.
Yeah, I think every crisis is different. I mean, COVID was different. We lived through that, and that was something that affected supply chains very quickly. And then, clearly, with everybody working from home, that was something that nobody had ever seen before. The GFC was different again. So I think each crisis is different. The great thing about private equity and the best private equity managers is that they can address themselves to help the companies and to help them through these crises. We saw that in COVID. We're seeing it now as well.
But do you think we'll see a shakeout in this industry of those who do well during this period and those who don't?
I definitely think there will be some big dispersion in performance, and it's happened before. If you look at prior crises, as you asked, then you tend to see there are winners and losers. The best managers are the ones that have operating expertise, sector expertise, and really apply themselves to helping their portfolio companies.
So doing the work then.
Doing the work.
Do you think then over the past 5 years there was some degree where it was almost too easy, that you didn't really have to do that work, that you could essentially, put leverage on a company and get better returns?
Well, I think a very wise man once said, a rising tide lifts all boats. So, yes, we've had 10, really good years. And, of course, there have been some managers that have really sort of ridden on the coattails of that. But I think now in this environment, the really good managers will come to the fore, and you will see the ones that have been, doing the best for their portfolio companies.
So you were discussing the type of deal that is most successful. What about when it comes to sectors? Are there opportunities in certain sectors right now and perhaps less in others?
So we look for long-term trends. So it's not really very much about now, the next 3 months, the next 6 months. We're looking for ongoing sector trends. So digitalization and automation is a trend which has been here for a while. It's not going anywhere because the world is getting more digitized. So that's a very big trend, and that leads us to invest in areas such as enterprise software, which is still only, still becoming important in industry. Aging demographics, so healthcare, another big trend for us, but anything which is really helping particularly developed economies with their healthcare issues, and that's really been accentuated by what's happened with COVID.
How are valuations in these areas? Because they are really clear, pronounced trends, it means that a lot of people see them and probably have interest in them. How do valuations look?
So valuations have been toppy in the tech sector, and we all know about the very speculative tech stocks that went through the roof during COVID. I think the key, again, is going back to what I said earlier about microsegments and looking for particular companies in particular microsegments that have got a lot of runway for the future and which the market will reward, I think, in the future.
How difficult is it to get financing in this environment?
So I think, again, for the right assets, it's fine. And for the right size of assets, I think as you go further up the deal size, it becomes more difficult. We tend to specialize more in the mid-market, smaller mid-market, and there you can still get financing for deals.
Do you foresee some of the big players, or perhaps it's already happening, the ones who are usually in large cap, then kind of moving down the food chain, as it were, if that's the place you can get financing?
Yeah, it's a good question. I think that it's quite difficult for those very big players because they have very large funds to deploy. So logically, I think deploying it in lots of small deals is going to be very hard for them. What we do see them doing, though, is making add-on acquisitions, and they often come down into the mid-market to buy companies in our portfolio, actually, to add on to their platform companies.
So just another thing for you to take advantage of.
Exactly.
Helen, so wonderful to talk to you. Of course, we're wrapping up right as the sun comes up, so perfect timing. Tom, I'm going to toss it back to you with that. Helen Steers, partner at Pantheon.
All right, excellent stuff. Danny Berger in the sun for us in Cannes with that deep dive on the PE sector. Thank you. Right, let's get you up to speed on what's happening with the BOE. We've had some repricing from these money markets. Take this, traders now fully pricing in a 25 basis point BOE rate cut this year. They're expecting now a terminal rate of 4.5%, The expectation is then that that moves to 4.25% by December. This, and the reason for this, is because of the UK factory inflation that came through in yesterday's data, rising at the slowest pace in almost a year. And here's the reaction then. The pound at 123, but the moves are really in the gilt markets, particularly in the belly of the curve. The 5s and the 10s, 7 basis points lower. A move lower by 7 basis points as money moves into gilts in the belly of the curve on expectations that the BOE could cut by the end of this year on softer factory inflation. We'll keep across that story. Developments within the central banking space and, of course, what it means for these money markets. Coming up, Germany and the US are said to be poised to provide tanks for Ukraine after months of reluctance. It's an important geopolitical turn of events. We have the details. This is Bloomberg.
We earmarked our 14 Leopards tanks, and now we wait also for Leopards from Denmark, Finland, Germany, and tanks from the other countries of the European Union, because we wanted to inspire others to actually gather more tanks to have potentially 60, 70, up to 100 of very modern tanks, which can make a difference on the battlefield in Ukraine.
We decided together with the United States that we will do something with special tanks.
If Germany gives own Leopard battle tanks to Ukraine, we will do this in line with the alliance.
And without it, it's going to be very tough for us.
Bloomberg TV, they're speaking to key decision makers at Davos as the US and Germany are poised now to announce that they will indeed supply Ukraine with their main battle tanks. For more and with the details, I'm joined by Bloomberg's Rosalind Madsen. Ros, when then could we start to see Western tanks deployed, moved into Ukraine?
Well, we're likely to get an announcement as soon as today confirming what we're hearing, which is they are indeed going to promise to send these tanks in from the US and from Germany, and of course Germany's allies in Europe, which have hundreds of these tanks sitting there that they can now send in with Germany's approval. So that could come as soon as today. Then there's a process of agreement about training. These are big Western-made heavy tanks. Ukrainians have been working on Soviet-era tanks, so they need training on these things, and that can take weeks for a start. So how does that happen? At what point then can you ship them in and have them operational where they need to be, which is probably in the eastern part of Ukraine? And if they have to come in from the west, it's a long way to travel. So we're talking possibly quite a few weeks before these tanks could be on the ground operational and doing what they needed. And is that in enough time for a potential Russian offensive that may come as soon as next month?
And part of the US rationale for not passing on these Abrams, not shipping them into Ukraine, is the complexity of these machines, the weight, the fuel, jet fuel, I believe, is used in Abrams. So to what extent can these actually have a practical impact, particularly if you haven't had Ukrainian military being trained on them already, or has that started? Well,
that is the question. The US tanks, the Abrams tanks, they're 70 tons and they take a huge amount of gas and they need a lot of maintenance in the field. And if you're not trained in maintenance as well as able to use them, it can present difficulties. There's questions about whether they'd be so heavy they're going to sink into the terrain of Ukraine. That said, they do work well with the Bradley fighting vehicles, which the US has also promised. And the Leopards, in turn, work with the fighting vehicles that Germany has said that they're going to send in. They work as its pairs and they support infantry on the ground. So overall, it probably is a big asset for Ukraine to have these things coming in.
Any sense of what the Russian response will be or has been?
Well, Russia has, since the invasion, said that certain types of weapons would be a red line for them and they'd retaliate. And we've seen them say that over and over again, and we've seen them not do anything really when that's happened. And so that the calculation really from Europe and the US is, well, we may as well send these heavy tanks in because the risk of a proper direct Russia retaliation must be low at this point. And certainly the risk of nuclear weapons seems to have faded, at least thankfully, for now. So they're taking that calculation that Ukraine really needs this if it's going to have any prospect of staving off an offensive. and perhaps even regaining some of the ground that Russia has been occupying. And certainly they're willing to take that risk with Russia at this point.
OK, it is a risk, it is a gamble, and it's been tortured getting to this point, but it's an important evolution in terms of where things stand between the US, of course, Germany and its allies on providing those tanks. Thank you very much indeed, of course, Bloomberg's Rosalind Matheson on the latest and how that story has evolved, the potential implications then for the fighting forces of Ukraine. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Shares in Adani Group companies are paring losses after the CFO denied allegations by activist investor Hindenburg. The short seller accused firms owned by Asia's richest man of, quote, brazen market manipulation and accounting fraud. Adani Group's CFO says the company has always been in compliance with the law and maintains the highest standards of corporate governance. Rupert and Lachlan Murdoch are abandoning plans to reunite their two media companies, Fox and News Corporation. Some investors had voiced opposition to the merger, saying it undervalued company assets. The deal, first announced in October, was widely seen as a way for Lachlan Murdoch to cement his control over the family media empire. The New York Stock Exchange says some trades will be declared null and void after a glitch caused wild price swings and trading halts in hundreds of stocks. The exchange says a system issue affected more than 250 stocks as trading started in yesterday's session without an opening auction price. Some of the biggest US firms, including Wells Fargo and McDonald's, were hit. Bank of America is rewarding the majority of its staff with a pool of restricted stock. The incentive, which comes on top of regular compensation, will go to employees who earn up to $500,000 a year. Bloomberg understands that around 96% of the bank's global workforce are eligible for the scheme. That's the Bloomberg Business Flash. Tom.
Laura, thank you very much indeed. Now to Pakistan, where the country's ousted Prime Minister Imran Khan says he's actually confident of returning to power this year. He told us the popularity of his PTI party has rattled every other faction in Pakistani politics.
The entire status quo, the entire political status quo is against me right now. So the 13 parties, they're all on one side and my party is up against them. And they're petrified because the reason why this assassination attempt was because they got scared of the popularity of our party. Since we were removed through a conspiracy on the 9th of April, on 10th of April, never have so many hundreds and thousands of people come out all over Pakistan and protest. It's never happened in Pakistan. So they got rattled by that. Then followed series of our public rallies, which were unprecedented. But what really scared them were the 36 by-elections that took place since, and 75% of them were won by us. So 29 out of 36 were won by PTI. Despite, the establishment on their side, the election commission favoring them, the administration was on their side. So that's what has really rattled them. If you look at any survey in Pakistan right now, all the parties put together cannot compete with us. In the by-elections, 13 parties stood on one ticket against us. And as I said, 75% of the elections were won by us.
Pakistan's former Prime Minister Imran Khan there speaking in Lahore. Bloomberg News is seeking reaction from the Pakistan government to Khan's comments. Coming up, Tesla's $3.6 billion investment. The company plans new facilities to build electric vehicle batteries and its all-electric semi-truck in Nevada. We get more details and look ahead to the company's earnings. Those results are due later today. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Move over Microsoft. It's all about Tesla now. Tesla investing $3.6 billion in two new factories to build electric vehicle batteries and its all-electric semi-truck truck. You can see that on the screen now in Nevada. The investment comes ahead of the company's quarterly earnings. They are due later today. To get a preview then, Craig Trudell, who covers global autos, joining us in the studio. Let's talk about the investments. Let's talk about the preview of the earnings. Let's start with the investments then. What is the rationale behind this for Tesla? What does it tell us about their appetite for expansion and the demand that they're seeing?
Yeah, we knew back in April of last year that Musk was talking about expanding their presence in Nevada. It was always the plan going in that this battery plant was going to be huge, right? That it was going to be bigger than anything in the world. And it actually has taken them some time to sort of live up to the scale of what they initially talked about for that facility.
Not for the first time.
Not for the first time with Musk. We're used to that, of course. And so they've been trying to scale up some of their own batteries. It's still a little bit unclear just how much this will be Tesla making its own batteries versus working along with Panasonic, which has been their approach thus far. And obviously the Semi is very interesting as well. Musk has talked about wanting to do 50,000 units of that next year. An analyst at RBC recently said he sees something more like 4,000. So we may see some more, classic Musk big promises with, questionable delivery on the other end.
Are we expecting big promises when we hear from executives later today on the back of the earnings? What are you and the team looking for within the earnings picture? What is going to be key for you?
I think it's a nuanced picture, right, where Tesla is, doing, record deliveries, quarter after quarter. The problem is that they haven't been doing deliveries to keep up with all this new capacity that's coming on. And so the extent to which, Musk can convince the street that, these price cuts that they've done recently can really lift demand or have lifted demand, and that he can, sort of balance these supply-demand, dynamics without sort of, giving away the farm in terms of margins. They've had fairly strong profit margins that have surprised a lot of the doubters that didn't think that EVs were going to be viable. But, does he get to a point where, Tesla is back to, break even or even losing money in order for him to continue to grow at the rates that he's promised?
And that takes us to the price cut story. And I've heard and I've seen different responses to this. Pretty significant price cuts, China, the US, the UK here as well. Some saying, that, look, this is a smart move. They're going to continue to build out market share. Others suggesting, yeah, there's going to be that margin squeeze. What's your take?
Yeah, I think there's no doubt there's going to be a margin squeeze there. The question is how much, they're able to sort of bring costs down and sort of offset that to some degree. In terms of their positioning, they absolutely are ahead of everyone else in terms of the amount of scale that they have in place to make electric vehicles and relationships with battery companies and some internal capabilities that they're attempting to get up and running. It's absolutely a question, though, of whether you're really not making friends with your current customers by slashing the heck out of their resale values. That is absolutely a big risk that they've taken.
Yeah, and you've certainly seen protests in China at some of the showrooms there on the back of those price cuts and not being afforded to those customers. Craig Trudell, always fantastic on the preview to Tesla. Thank you very much indeed. A redhead crossing the terminal now. Adani Transmission extending its slide to over 12%. Again, this is tied to the story. Hindenburg Research, 2 years of research, and they are claiming, and it is claims, that there is fraud at the Adani conglomerate. The CFO coming out saying they have the strictest corporate standards and they always abide by the law. That's just the latest on that evolving story. Adani Transmission, part of that conglomerate of Adani businesses. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York, Anna Edwards here in London. European markets off by 0.6%. NASDAQ futures down a full 1%. This is Bloomberg.
I don't think we're heading here into a severe recession. I think, the business cycle dynamics are not late cycle. This is an early cycle economy.
It's all about picking stocks in this environment. If you look at CEO confidence in the economy 6 months out, it's at an all-time low.
The idea that this is all behind us in the economy, I don't think that's true at all.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. A warning from Microsoft. The company is forecasting a slowdown in both its cloud computing business and corporate software sales. An unprecedented strike today by Amazon workers in the UK. They're unhappy with the online retail giant's latest pay offer. And activist investor Hindenburg is targeting Asia's richest person. It accuses firms controlled by Gautam Adani of fraud and market manipulation, charges the company denies. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz in New York. Matt Miller is off today. A lot to discuss today, Kailey, and one of those things is, of course, the tech sector, Microsoft and what it had to say, weighing on sentiment as we head towards the US Open.
Yeah, you definitely are seeing that deterioration in U.S. futures. I would note it didn't weigh too much on sentiment in Asia overnight, but that may be because a lot of those big Chinese technology stocks were not trading today because China and Hong Kong are still closed for the Lunar New Year holiday. What was trading includes Japan, and stocks there were modestly higher, the Nikkei rising by about 3 to 0.4%. That may in part have had to do with the fact that the Japanese yen was weaker against the dollar earlier in the session, but it has actually gained back strength. It's now stronger by about 0.25%. Dollar yen trading at 129.81. Also stronger against the U.S. dollar. The big outperformer in G10 today is the Aussie dollar. It's stronger by about 0.6%, trading at just under 71 cents to the greenback. That is after we got Australian inflation data out overnight. It accelerated to the fastest pace in 32 years, suggesting that maybe the peak is not in, and bond traders have been underpricing policy tightening by central banks. May throw some cold water onto that whole pivot thesis, and that is what you saw playing out in the Australian bond market as well. That two-year yield rising 10 basis points to 3.08%. Here in the U.S., though, the story is less about concerns around inflation and monetary policy and really more about earnings after that disappointing guidance on the cloud growth from Microsoft. So that is weighing on stocks across the board. We are right around session lows right now. S&P 500 futures down about 0.7% to just about the 4,000 level, 4,003 where we trade at the moment, but the real underperformance coming from NASDAQ 100, of course, very tech heavy. Those futures are down more than 1%. In other asset classes, meanwhile, it is more quiet. We're down just 2 basis points on the 10-year yield to 343, and then crude oil barely changed on the day. We're down less than 0.1% on WTI, right at $80 a barrel, Anna.
Kailey, let's have a look at the European map. And while we do so, worth reflecting on those Australian inflation numbers, because for some people, this tells us that broader story may be about whether we've reached peak inflation. For others, other voices I spoke to this morning saying, actually, this stays in Australia and it doesn't have much global read across, but no doubt a conversation that will return. This is the European picture this morning. Negative, and increasingly so, actually. As Kailey's been pointing out, the futures picture in the US looks weak, increasingly weak because of the heavy weight that Microsoft is applying, if you like, to sentiment within the tech sector, and that is increasingly pushing down European stocks. So we're down by 0.5% on some of these markets. Basic resources, one area of brightness, that's helping to lift or at least flatter the London market. Here's a European tech name that's in focus, ASML down by 1.5%. The numbers well received by analysts and the company reporting numbers that were better than had been anticipated, but there are still big concerns around tech broadly and indeed specifically around chips and chip equipment suppliers, as ASML is. To what extent are they going to be able to supply the China market? Still an open question. Talking about negativity around tech, this is a small Danish business, works in the IT space. That stock down by just shy of 20% after the company put out some numbers. They seem to disappoint analysts, and we saw some downgrades from analysts. EasyJet, though, reporting something very different. A lot of focus on consumer-facing businesses in the UK. How will they stand up through the winter, given the cost of living crisis? Have we seen, really, the intensity of the cost of living crisis, though, for consumers? And that's one of the questions that is raised when you look at what's happening with EasyJet. They're still reporting strength in their bookings trends, including for that important summer period, and so the airline goes higher by 10.5%. The euro down at 108.78. It has been over 109 earlier on this week, Kailey, as we talk about whether we'll see multiple 50 basis point hikes from the ECB, of course. The data point today was around the IFO, and it really did come in to support, essentially, what we've been hearing from a number of other names, including now the German government. Expectations are fading that the German economy finds itself in a prolonged recession this year.
And the soft landing chorus and data that seems to support it just continues to grow louder, Anna. Now let's return to our top story of the day, what is really defining the market action in terms of risk sentiment here in the U.S., a downbeat forecast from Microsoft. The software giant says revenue growth in its Azure cloud computing business will decelerate in the current period, and it warned of a further slowdown in corporate software sales. Bloomberg's April Roach is joining us now for more. So April, we know that the tech sector and growth in it has slowed broadly. Microsoft clearly not faring well as that goes on.
Yes, so Microsoft reported a second quarter sales gain of 2%, which was expected, and this was the smallest increase that the firm has reported in 6 years. However, its profit did beat analyst estimates, and this was helped by the strength of its Azure cloud services business. And we've really seen how these big tech giants like Amazon and Meta have struggled a bit in a kind of slowdown period, which comes after a surge during the pandemic. And many of these companies have said that they are taking measures to adjust in this period.
Yeah, absolutely, April. That's the story then around some of these big tech names in the US, which we continue to focus on. We also got numbers out from where you are, from ASML, the major supplier to the chip sector. The numbers didn't seem so bad, but the stock falls. Tell us some of the details.
Yes, that's right. So ASML's sales forecast for the first quarter of the year beat analyst expectations. The company was able to maintain its long-term revenue guidance while also providing an outlook for 2023. It sees a sales growth of more than 25% for the year compared to 2022. And as you said, you know, the stock is down slightly, which could be on the profit look, which analysts might have been expecting to be a bit more positive. But regarding demand for ASML's advanced machinery, the Chief Executive Officer, Peter Wenick, said in a transcript of a video interview that while the firm does face challenges regarding a potential recession and inflation and geopolitical tensions, the demand is still much higher than what they can make.
April, thanks very much. Bloomberg's April Roach with a focus on US and European tech. And in fact, let's keep with the tech-related news. Amazon workers in the UK are going on strike for the first time ever. Bloomberg UK correspondent Lizzie Burden has been on the picket line with strikers this morning. The strike organiser telling her the walkout is about more than pay.
This rise isn't going to impact how Amazon does business. What it will do is actually start to bring some of that money that Amazon generates back into the economy. These workers are going to spend all of those wages in the local area, actually bringing profits back into it. Amazon doesn't do that. This is about trying to build sustainable jobs and actually jobs that these workers really can value.
Lizzie Burden joins us now from Coventry in the English Midlands. What's the latest where you are then, Lizzie?
Well, Anna, you can see the union set up camp outside the entrance to the Amazon warehouse. It's stopping workers on their way in, asking if they want to join the union, join the strike. They're expecting at least 300 workers to join today, and they're asking for a 50%, 50, raise to £15 an hour. They say the workers need it to deal with the cost of living crisis. They say they deserve it because they've grafted through the pandemic, and they say that Amazon can afford it because it only paid £10 million in tax in 2021 on about £200 million of profit. That's their argument. Amazon, though, says it's very proud of the wages it pays. They're competitive, they're above the national living wage. The union says that's nothing to brag about and that it's going to continue strike action potentially in the coming weeks and months if Amazon doesn't come to the table. But remember, Anna, Amazon has its own issues. It's dealing with people going back to their pre-pandemic spending habits, and it's also having to cut 18,000 jobs, the biggest cull in its nearly 30-year history. It's closed already it's closing 3 warehouses, opening 2 others. Amazon too has its issues.
Well, Lizzie, speaking of issues and how broad they may be, this is not the first time we've been speaking with you about strikes in the UK, but largely that has been a conversation about the public sector. How significant is it that the strikes are now spreading to the private sector?
Indeed, Kailey, we've seen chaos across the public sector, from healthcare to transport to teaching to the civil service, and it is significant that it's now spread to the private sector because it shows the discontent has grown. But it's also significant economically because it gives new meaning to the idea, the warnings of a wage price spiral. We've seen persistently, stubbornly high inflation in the UK, wage growth at its fastest on record in November outside the pandemic. The difference between Amazon and the National Health Service is that Amazon could raise its prices to cover a bigger wage bill. However, as you heard from the union boss there, they think Amazon's got the margins to absorb a bit of a pay rise.
Lizzie, thanks very much. Bloomberg's UK correspondent Lizzie Burden at the Amazon warehouse in England. Now, shares in Adani Group companies are dropping after allegations from an activist investor, Hindenburg Research. The short seller accuses firms owned by Asia's richest man of, quote, brazen market manipulation and accounting fraud. Adani Group's CFO says the company has always been in compliance with the law and maintains the highest standards of corporate governance, denying all of those allegations. For more, let's bring in Bloomberg's Sanjay PR in Mumbai. Sanjay, what are the key allegations from Hindenburg's research? Of course, we've mentioned that Adani denies all of this, but what is it that has been said that is weighing on the shares?
So largely there are two, like account manipulation and fraud. The allegation is saying that the conglomerate, the port power conglomerate, has created shell companies from countries like UAE, Caribbean islands and Mauritius, and that has led to tax theft, corruption and money laundering, etc. These are the charges alleged by the US research firm. But Adani CFO had denied all this allegation, and they also said that the timing of this particular report is today, which is Adani Group's flagship company, Adani Enterprises Limited, is launching a follow-on issue, which is India's largest follow-on issue. So the timing is he has also criticized the timing of this particular research report and the follow-on issue. So, and the stocks has not reacted to that, largely towards that, because by then the CFO has intervened and has made these kind of statements towards investors.
Yeah, on that point, the CFO said that the timing clearly betrays a, quote, brazen, malified intention to undermine and damage the share sale plan. So what happens next with that?
So the next important thing would be the FPO, because FPO opens today, and FPO is going to be the largest in the country. What we pick up from the company is that they are getting a great response from sovereign funds like IHC, Mubadala, ADIA, and others, and of course Indian domestic financial institutions such as LIC, Life Insurance Corporation, and other domestic financial institutions are also very keen to invest in this follow-on offer. So they are saying that this timing could be wrong, but they are believing that this follow-on issue of Adani Enterprises Limited will be a resounding success. We will have to wait and watch for more further stock exchange disclosures on the bids received from these financial institutions across the world.
All right, Bloomberg's PR Sanjay in Mumbai, thank you so much for your reporting on this. So we know the stocks tied to Adani are on the move today. Let's also take a look at some stocks on the move here in the U.S. And I actually want to begin with News Corp, which is one of the few outperformers on a day when most stocks are lower. Rupert Murdoch yesterday saying he is abandoning plans to pursue a remerger between News Corp and Fox Corp. Of course, News Corp investors had been pushing back rather publicly against that, saying it undervalued the assets of the company. So they seem to be cheering the idea that that plan is no longer going to go forward, because News Corp is up about 4.5% before the bell. A lot of other stocks moving lower, though, and that includes Amazon. And partly this is part of the broad sell-off we are seeing in technology. But remember, Amazon is becoming more and more reliant on the growth driver that is AWS, its own cloud computing business. So the idea that Microsoft was out yesterday talking about slow growth in its own cloud computing business going forward has a negative read-through for this company. So that stock is down about 1.9% before the bell. And there's a lot of other stocks moving lower as well, many of them tied to analyst recommendations and specifically analyst downgrades. Sunrun got downgraded at Barclays. It's down 3.5%. Block was downgraded at Oppenheimer. It's down 4%. Enphase Energy getting a downgrade as well from Piper Sandler. So that stock is down about 3.9% before the bell, Anna.
Okay, certainly those having an impact then. Coming up on the programme, we'll get back to the big tech themes then, Kailey. More on Microsoft's results with Walter Todd, Greenwood Capital President and CIO. He joins us to talk about what we've learned on costs in the tech sector, any clues around CapEx. What will other cloud companies manage to achieve, given what we've heard from Microsoft? And forecasting a recession has never been trickier, apparently. Today's Big Take story dives into why traditional economic indicators may not be as reliable as they were in the past. Look for that online or on the Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz in New York. Matt Miller is off today. Now, options markets imply we are past the peak in volatility for fixed income assets. Our markets reporter, Valerie Teitel, is here to discuss and to give us a sense of what this means for broader risk-taking in markets. Valerie.
Yes, Anna, I think this decline in fixed income volatility especially is really going to spur a further risk-on mood this year, and I'll tell you why. We are now well past the peak in fixed income vol. I've got the MOVE index here in blue. That is a measure of implied volatility in the Treasury market. Now, it's peaked, and it peaked just over 90 days ago, and I'll tell you why that's important. Most banks on Wall Street, most asset managers, they have these VAR models, these value at risk models. The main input into that is 90-day historical volatility. So as that historical volatility starts to roll off, their portfolios start to look less risky, and what does that spur them to do? Move further out the risk curve, go into equities, move into more risky assets with juicier yields like EM bonds. So this is a main reason why I think we are not done yet with this risk-on move that started in January.
Okay, Valerie, thank you very much. Bloomberg's Valerie Teitel with the link between volatility and risk-taking and why one could follow the other. Joining us now, Eddie van der Velde, Bloomberg Markets Live editor. Eddie, interesting thoughts there from Valerie around risk-taking, and I wonder how this ties into broader themes around recession, because I know that's been firmly on your radar. We have this big take story out today talking about how difficult it is to read the tea leaves on recession. There are many models mentioned in that story, the SARM rule for one, and that's an example of a model that's not really giving us any clear clues right now.
Yeah, and you know what, Valerie makes a really good point about the markets reacting to this, but the Fed, of course, is going to react to that, to this dip in volatility too, because they look at financial conditions. And markets, at the moment, there's a really big feedback loop between what's happening in markets and what's happening, you know, with central bank policy, because as financial conditions ease, the Fed becomes less likely to cut or to soften their stance, and that again feeds back into markets. So it's a really interesting situation in markets. With regards to the economic indicators, I think we've got to separate the echoes of the pandemic and the previous recession from the readings that we're getting that are really truly forward-looking, and I think that is what's messing with people's models at the moment. We are just coming out of one of the sharpest recessions we've ever had, and that is going to have, that causes these sort of these echoes that are playing forward.
Okay, Kailey.
Well, Eddie, if we're coming off of the shortest, sharpest recession we have had, it raises the question of if we still will have a recession this time around. And if you look at the yield curve, which is still inverted by 71 basis points on 2s10s, that would signal that, yes, it's coming. How do we think about those clues?
Kailey, absolutely. The yield curve is one of the really big one, because it has almost always been right. The problem with the yield curve this time around is that very high inflation that we have, right? And if you assume that inflation is going to be much higher, or is much higher now than it is going to be in a year's time, then it makes sense for rates also to be very inverted and to say that rates right now is much higher than they are going to be in the future. So I do think that there is a lot of separation. We've got to look at the economy on a much more objective basis than purely looking at the data. I think we've got to look at is the jobs market telling us that that the economy is strong, or is the jobs market telling us that the economy is rebalancing? And I think the latter is much more accurate.
Okay, Eddie, thank you very much. Eddie van der Velde of Bloomberg Markets Live. Big Take is the function to use on your Bloomberg terminal if you want to see more on that Big Take story. You also find the Big Take podcast on there as well. MLIV Go is the function if you want to get more from the Markets Live team, of which Eddie is a part. You can find that on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Ukraine will soon get a powerful new weapon to use against Russia. The U.S. and Germany are set to announce they'll provide their main battle tanks. The Biden administration will offer the M1 Abrams, dropping the argument that it guzzles too much gas and is difficult to operate. And Germany is expected to send 14 Leopard tanks. The hope is the tanks will let Ukraine punch through the Russian lines. Bank of America is rewarding the majority of its employees with a pool of restricted stock. It's an attempt to retain workers in a gloomy economic environment. About 96% of BofA's global workforce is eligible. It's the 6th time the company has offered such stock awards. Rupert Murdoch is dropping plans to recombine Fox and News Corp. In a letter to both companies, he said that combining the two media giants that he controls isn't optimal for investors. The controversial deal aimed to reunite the parents of Fox News and the Fox broadcast business with the print operation that includes the Wall Street Journal, the New York Post, and HarperCollins. And the New York Stock Exchange is canceling some trades after a glitch during yesterday's open. Hundreds of securities began trading without an opening auction price. The NYSE didn't elaborate on what it called a system issue or what it may cost. Quite a mystery there. Well, coming up, we will turn to the broader markets and talk Microsoft with a shareholder. Walter Todd of Greenwood Capital will join us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A warning from Microsoft. The company is forecasting a slowdown in both its cloud computing business and corporate software sales. An unprecedented strike today by Amazon workers in the UK. They're unhappy with the online retail giant's latest pay offer. And activist investor Hindenburg is targeting Asia's richest person. It accuses firms controlled by Gautam Adani of fraud and market manipulation, charges the company denies. I'm Anna Edwards in London with Kailey Leinz in New York. Matt Miller is off today. And Kailey, we're getting towards the start of US trading, of course, some way through the European trading day. Sentiment fading as if the negativity around big tech is sticking.
Yeah, and that negativity seems to be growing as the future session grows older, Anna. We've been down the whole time, but we are right around session lows now, and really those losses are being led by tech-heavy indexes like the NASDAQ 100. S&P 500 futures, for their part, are down only by around 0.8%, but NASDAQ 100 futures are down by substantially more, about 1.2%, and that is something, as I said, that just continues to build momentum as we grow closer to the opening bell, which is in about 4 hours' time. In other asset classes, it is more quiet. The 10-year yield down about 2 basis points to 3.43. Oil's doing pretty much nothing. It's down less than 0.1%. WTI hanging out right around $80 a barrel. It really is an earnings-driven story for U.S. markets today. So on that note, let's talk about Microsoft. As Anna said, they are warning of slowing growth in the cloud computing business, and that really turned things around for this stock, which initially gained after its results because they were better than feared. The forecast, though, perhaps worse than feared. So that stock is down about 2%, and it's dragging on some of its peers as well, like Amazon, which of course operates that giant AWS cloud business of its own. Not a great read-through for that company. That stock is down about 1.7%. And of course, Amazon will be reporting its own results next week. Interesting to see Texas Instruments not trading at this point in the pre-market session because it too reported after the bell the slowest sales growth going back to 2020, and the guidance also was pretty tepid, so really speaks to the slowdown one of the largest chip makers is feeling at the moment. And then Tesla will be reporting after the bell today. A lot of questions swirling around about demand for those cars. Also, the man himself, Elon Musk, who runs this company, Tesla stock down about 1.6% ahead of those results. But of course, that is just part of the broader deterioration we are seeing in big tech stocks this morning, Anna.
Yeah, absolutely. The sentiment around big tech certainly evident there then, Kailey, and certainly evident here in Europe as well. We're down by 0.7% on the SOX Europe at 600. In fact, it's quite broad-based. Technology is one of the sectors that is under pressure. Telecoms, financial services also feeling the pressure. In fact, only one or two sectors in positive territory through much of this morning's session. The basic resources sector was one that was underperforming yesterday, so outperforms today. ASML is a sort of European expression of that tech nervousness, Kailey. We're down by 1.8%. There's the broader stories around tech, but there's also what we heard from ASML themselves. The numbers themselves not that bad, better than expected on a number of levels and well received by analysts. Some questions, though, as to what this business will look like if they do have to stop supplying some of their big lithography machines to China. That is what they make. They supply the makers of chips. EasyJet from the aviation sector down by 9.5%. A lot of focus on how resilient these kinds of consumer-facing businesses can be in Europe as consumers deal with all of the headwinds they're being being faced with. But quite resilient so far is the message coming through from EasyJet, where they say that bookings are resilient into the second quarter and crucially then into the summer. And so the stock, a little bit of relief there, up by more than 9%. And the euro fairly flat this morning, 1.08. It has been above 109 as we continue to track the ECB story. The development, though, this morning has been around a German sentiment, and that number coming through from the IFO Institute pleasing some, and so reinforcing the sentiment that perhaps we're getting better data out of Europe, Kailey.
All right, so perhaps better economic data, but not necessarily better corporate earnings or corporate guidance at the very least. Let's get back to the Microsoft story, as that tech giant issued a downbeat forecast regarding its cloud business. Joining us now is Walter Todd, President and CIO of Greenwood Capital. Microsoft is one of his top holdings. Walter, good morning. Thank you for waking up early for us. How are you feeling about that Microsoft position this morning?
Yeah, well, we do have a position in Microsoft, but we're about 50% underweight the index. Look, I think Microsoft's a great company that's not a really good stock at the moment. And really, if you think about the call yesterday, it was kind of two separate calls. Satya Nadella had you kind of dreaming about the future and the new platform of computing and AI, and then Amy Hood, the CFO, came on and kind of slapped you in the face and gave you the outlook. Again, it's all about expectations. They're still growing the cloud business in the low 30% rate, but that's down from 38% the past quarter, and it's down, from over 40% a year ago. And they were quite honest and upfront about what they're seeing in terms of spending, customers being more conservative given the macroeconomic uncertainty, and they saw a slowdown as they exited the quarter. And I think that's what really has the stock down this morning a couple of percent.
So, Walter, this is a company that was growth and is not growing to the same degree anymore. And I wonder how that translates to other companies like it, other stocks that you hold in your portfolio, the likes of Apple and Alphabet that we have yet to see results from. How close do you think the correlation or the read-through is for other big tech names?
Yeah, I think it's probably consistent with what we're going to hear from other companies. And really, this has been a story for the past really 12 months plus of the top of the market underperforming the average stock. And so when you look at our portfolio specifically, we're underweight tech, we're underweight the top of the market, and have a lot of weight in some smaller names relative to these mega cap names. So I think it's a consistent theme we're going to be hearing as we move through earnings season from these larger companies. And I think the stocks are going to continue to be a little bit challenged here.
Walter, good morning to you. Yeah, last year was all about valuation, wasn't it? About a rising rates environment and what that does to the value of big tech. Is this year going to be about concern for top-line demand? I mean, what do you make of expectations for how much companies are going to spend on tech products? We heard from Microsoft on this front. We've also heard from a number of European corporates raising questions about CapEx and whether companies are going to have the appetite.
Yeah, I think spending on technology is as Jamie Dimon would say, is kind of, you can't sacrifice that. It may slow, but they're going to continue to spend. And I think that's what you heard the message from Microsoft is customers are trying to do more with less. Technology helps them do that. And I think what you're seeing from these big tech companies and other areas of the market as well is people are right-sizing their cost structure. So Microsoft talked about that last night, and we heard about laying off some people, right-sizing their cost structure to align with the slower revenue growth. And I think we're continuing this process of reevaluating valuations given the prospect of rising interest rates and slowing economic growth. I think investors were quite euphoric here to start the year as they think about the prospect of the Fed stopping raising interest rates, which is great, but now we have to shift our attention to the future and potentially slowing economic growth as we move through 2023.
Yeah. And Walter, we've seen some positive stock reaction to companies that announce layoffs, and you can understand why that happens from a margin perspective. But for how long does that remain a kind of good news story, if I can put it that way? Obviously not good news for the people who are laid off, but in terms of the market's perception of it.
Yeah, I think that's a short-lived reaction, and I think as companies continue to move through the course of 2023, and we get further down the road, I think it's going to come back to what is the revenue growth outlook, and what is the kind of economic backdrop for that. So I think the cost cuts can only get you so far. You can't cut your way to prosperity, and then we're going to have to see some reacceleration in revenue. But unfortunately, that might be a 2024 story, not a 2023 story.
Okay, so for that 2023 story, when we're thinking about corporate earnings, top line and then bottom line as well, Walter, Has the bar been set appropriately, or are expectations still too high?
Yeah, I think for the current quarter, I think expectations were somewhat subdued when we started the year, and then we had, pretty big rally heading into earnings, so that bar may have been raised a little bit. I still think earnings in aggregate are probably too high for 2023 and need to come down. They've come down for the S&P from around 252 to around 227 right now. That probably needs to go further down to maybe 215, something of that nature. So I think there's continued earnings risk as we move through the year.
Okay, and what do you make of, going back to Microsoft specifically, we've seen this business, of course, it operates in a number of areas of tech, and one of those areas is gaming, and they have these ambitions towards Activision. What did you make of the comments they made there? I mean, how much sense does it make that is still part of the business?
Yeah, it's a real head scratcher for me, honestly. I mean, when you look at the trends in gaming and Xbox specifically that they reported last night and they were really seen for the past number of quarters, I don't understand why they're continuing to pursue Activision, honestly, especially given the out with the lawsuit. It seems like they could use that as a means to step away from that deal, but they indicated last night they're intent on closing that transaction.
Walter, thanks so much. Thanks for joining us. Walter Todd of Greenwood Capital with us to talk about tech. And while we were having that conversation, some headlines dropping across the Bloomberg terminal, which we should get to right now. Red headlines telling us that Germany has confirmed it will send Ukraine 14 Leopard battle tanks, this being described as a first step. Germany also will allow allies to send Leopard tanks to Ukraine. This crucial because Poland had specifically outright asked whether it could do that. It needed Germany's permission to do that. We'll wait for further details on the US side. There's been talk about the US being poised to send Abrams tanks as well. We'll see how that goes down. The Kremlin warning that tanks that are sent by allies to Ukraine would be, in their words, destroyed on the battlefield. So we'll keep that in mind as well, the Kremlin's response. That breaking news just being confirmed right now. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with United CEO Scott Kirby. That's at 11:30 a.m. New York time, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Kailey, Leinz in New York, and I'm Anna Edwards in London. Just getting breaking news coming through from Berlin. Germany has agreed to supply Ukraine with 14 Leopard 2 battle tanks. They will also allow allies to send Leopard tanks to Ukraine. Let's get further details. Rosalind Matheson joins us, Bloomberg Senior Executive Editor for Government, with details. And Ros, good morning. This seems to be, as expected, I suppose, in the last 24 hours at least, the pressure building and building on Germany to come to this conclusion.
Well, that's right. We've seen pressure for weeks on Germany from Poland, from other countries in Europe, because they can't send the Leopard tanks that they have in their stores until Germany gives them the right to do so under re-export laws. So they're sitting there. They wanted to go. They had to get the go-ahead from Germany, and they were saying that time is running short to be able to get these tanks to Ukraine, to get Ukrainians trained on how to use them also, because they are very different kinds of tanks if they're going to make any measure of difference in the coming months. And it's possible either way, the timeline for this still will be weeks, if not months.
So, Ross, to that point, as you say, this took a long time. It was difficult to accomplish. What is the broader signal here about that difficulty and what it says of the resolve and unitedness of the allies and whether that's fraying?
Well, certainly you've seen a huge amount of unity and support for Ukraine from Europe, from the US and elsewhere, and really a lot of aid that's gone in over the past 11 months, be it financial aid or military aid. What you see is sort of a staggered level of caution, and not just Germany, but other countries too, about if you send really offensive heavy weapons into Ukraine, does that put NATO in the firing line directly with Russia? Is that seen as a direct challenge to Russia, and does that pull those countries into a conflict that, you know, is contained inside Ukraine? And that's been Germany's concern, and other countries also. But equally, you've seen other countries in Europe saying Germany has just been far too cautious, especially in the past few weeks.
Yeah, and any response from the Kremlin, of course, will be closely watched here. I suppose, talking of unity then, Germany has always made the, well, some voices in Germany at least have made the argument that they didn't want to do this alone, and maybe they like the cover of other NATO members, for example, the US, sending their own tanks. We'll wait to see if we get confirmation on that, because at the moment that's just our sources suggesting that'll happen.
Well, that's right. It's interesting, though, that we are hearing that the US will commit to sending Abrams tanks. Those are the very heavy US battle tanks. That could take even longer, by the way, to get there. But the suggestion is that Germany was making very clear to the US, if we're going to send ours, you need to send yours, because the US was resisting sending these very big, heavy battle tanks from there. And so perhaps there's been that conversation behind the scenes, which is we really have to do this together. If we're going to make this commitment, so do you. So you can imagine that's what's really happened in the past few weeks, is that negotiation. So we are expecting a potential announcement on Abrams, as you said, later today from the US.
And we'll await that. But can we also, Ross, just get a sense of what the war is looking like on the ground now? Ukraine obviously wanted these tanks as they prepare for potentially a fresh offensive from Russia once the weather changes. What are you hearing about what the scene actually looks like?
Well, what we've seen for weeks is things are very, very bogged down on the ground. Neither side really making much progress at all. We're talking like meters, if anything, and one or two small towns that are changing hands. And really, as the weather changes, we get through winter, there's the moment where either side could really launch an offensive. Russia may make another fresh push to try and regain some territory. Ukraine equally will resist that and try and reclaim some of the territory it's lost. So they're on the clock here as the weather changes, as the terrain changes. The reality is, though, that these tanks could take months to come in, and by then we could have really seen the situation change on the ground. So the question is, at this point, would they come too late?
Ros, thanks very much. Thanks for the update. Rosalind Matheson joining us there, Executive Editor for Government, with the latest on the supply of tanks to Ukraine. Coming up, Tesla's out with earnings later today, so we'll get back to the corporate news and the business reporting cycle. We'll preview what to expect next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards in London. Matt Miller is off today. Now a look at what is coming up for the rest of the day. At 7 a.m. Eastern Time, German Chancellor Olaf Scholz will be speaking in the Bundestag. And of course, that follows the news, the confirmation that Germany will be sending Ukraine 14 Leopard battle tanks in what it calls a first step. It will also allow allies to send Leopard tanks to Ukraine. Then also happening at 7 a.m., we will get data on U.S. mortgage applications. Then at 10, it's Canada's rate decision. The central bank is expected to raise rates one more time. And finally, after the bell, we're going to get earnings from another tech giant, Tesla. We'll be reporting, Anna.
Yeah, absolutely. Now for a preview of Tesla's earnings, we're joined by Craig Trudell, Bloomberg's Global Autos editor. Craig, good morning to you. So the focus, as always, on the pace of delivery, on demand, on profitability. What will you be watching for?
Yeah, I mean, this is going to be one of the more interesting ones that I can think of in quite a while, right? They ended the quarter at Tesla really with a lot of signs of demand not meeting expectations, both their own expectations and what the street was hoping for. They were cutting prices, they were cutting production. The question now is these price cuts that they've made in the last few weeks. Really substantial ones in China, in the U.S., in Europe. How much have they sort of, helped perk demand back up?
Yeah.
And, will demand get to, all of this capacity that they brought online last year?
Well, it may help demand, Craig, but I can only imagine it will hurt on the margin side and hurt profitability. How much have expectations of that been lowered?
Yeah, we've seen EPS for the fourth quarter, drop back to like April levels, right? And so consensus really came down quite a bit. I think, forward consensus is also, coming down an awful lot for 2023. The expectation being that, Musk has said he's willing to compromise in terms of profit margins, perhaps even, bring Tesla back to where it's, just breaking even. And maybe even losing a little bit of money. He's willing to do that if it means growing at the rates that they've talked about. He really, talks about this idea of, wanting to dominate, wanting to one day get to 20 million units. I think a lot of people in the auto industry sort of, really look askance at a number like that. But this is the long-term ambition of this company.
Well, Craig, let's talk about Elon Musk, the man, then, because the Musk factor, in some sense, is unquantifiable. You know, that doesn't going to show up on the P&L. And we were just hearing from Musk over the last 2 days as he testified in a trial of a securities fraud lawsuit relating to his funding secured tweet back in 2018, taking Tesla private at $4.20 a share. And that is far from the last time over the last 5 years that he has made a lot of noise on Twitter and with his acquisition of Twitter. Is he going to be on the call today? I mean, what is going on inside Tesla in regard to faith in Musk's leadership?
I think that's another reason why this is going to be one of the more intriguing earnings sessions for them that I can remember. The amount of activity that's transpired since their last earnings call, that was around the time that he was closing the Twitter deal. The activity since then, it's really difficult to keep up. The many controversies and mistakes that he's made since then. And so, I do expect him to face some questions about his handling of the Twitter situation, the extent to which he's exposed Tesla investors in the course of all that, and, what he's going to do going forward to kind of, put Tesla investors at ease and assure them that, his eye is on the ball and Tesla's going to get back to the sort of execution, people sort of, got to take for granted when this, company was rising in valuation.
Thinking about focusing on execution then, Craig, how will other projects go down with Tesla investors? So even within the business, there are other things happening like Cybertruck development or in-house battery cells. All of these have the potential to maybe be successful, but also to distract. How are those going to go down?
I think you hit the nail on the head in terms of the two that I'm most interested in. Cybertruck, just how much volume can we expect for that this year? It's very much behind schedule. I think there are a lot of questions about, just how divisive that the design of that vehicle is and how much of a market there is for that model. And with the batteries, they just announced a big investment in Nevada overnight. How much of the batteries that are coming out of the new facility or the expansion of their complex in Nevada, is going to be batteries that they make in-house and sort of, deliver on some of the promises that Musk made a couple of years ago at a Battery Day event that got everybody excited.
Okay, Craig, thanks very much. Bloomberg's Craig Trudell joining us there with a focus on the auto sector. And that's interesting, isn't it, thinking about whether they make those batteries in-house, Kailey, because that make or buy decision, clearly at the heart of many boardrooms right now, as we've come through a pandemic with many supply chains tested, a lot of businesses focusing on that. But that's just one of the things we'll be watching for then in these earnings from Tesla.
Yeah, there's going to be a lot to watch for in the earnings themselves and also the commentary on the call, Anna, because this has been one of the stocks to watch. It's down about 1.4% in pre-market trading. I do wonder, though, how much that is in anticipation of the results and how much that is just part of what we're seeing broadly with these large cap tech names after Microsoft. That is what is dragging on the broader market as well this morning.
Yeah, absolutely. NASDAQ futures now down by 1.1% as we continue to digest what we heard from Microsoft. Interesting conversation earlier about the extent to which this negativity weighs on others that provide cloud in the sector and the extent to which it doesn't. We had an interesting conversation on Microsoft earlier.
Yeah, and that's going to be a question when we await more big tech results, like from Amazon, which, of course, is a giant in the cloud with AWS. It's going to be reporting on February 2nd after the bell, I believe. So Microsoft was really just the first out of the gate, Anna. We have a lot more of these to go, and we know, given the weightings of these companies as they go, the broader market tends to go with them.
Absolutely. We've got tech this week. We've got big tech next week, of course, as well, along with the Fed. A lot of people wondering which is going to be in the driving seat in terms of sentiment. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.